Now let's go through what's happening in the U.S., looking at the consumer, what's happening with wages, and then, where is the federal, the fiscal cliff really coming from that we want to talk about? Because we're coming to the end of the extended benefits on unemployment, though that some of that is being taken up with the child tax, the payments for different children based on child's age. So these are some of the things that we want to look at, but some of that, again, even that side of that child benefit is being included in these numbers. So when we look at the federal fiscal relief and stimulus as a percentage of annual GDP, you can see it's essentially comparable to the New Deal when you look back to, obviously the 1930s. So Biden's 3 plans in COVID-19 relief, which is that Trump relief plan, you get an idea that we're at 43.2% of annual GDP. Now, it bears pointing out that percentages, it's just a law of big numbers. So let's just think about the law of big numbers in general when you look at just where things sit, because GDP in the 1929 to the 1930s calculation is going to be a much smaller number than obviously where we sit today on a GDP level. So just the percentages are similar, but obviously the gross numbers are massively bigger. And that's when we start looking at how is this going to be paid for, that's when we start looking at treasury issuance and how we continue to be on this expansionary plan where we're not only rolling previous debt, but we're adding new debt to it. So then when we look at the shrinking pile, so the Treasury cash has shrunk by about 1.5 trillion since peaking in July of 2020, and it's now at 314 billion, which is the smallest since December 2019, after obviously that big increase last year due to the ramp up in borrowing spending to combat the shutdowns. So this is when we start looking at, okay, well, how much cash is on the balance sheets? When do we start coming to this concern of, okay, well, we're hitting the debt ceiling, so we have to increase the debt numbers, which is why when we look at what is continuing to come, it's going to be an increase in debt levels. It's going to be an increase in rolling, which is why we talk about rates going back up, some of that pressure as we continue to see this accelerating debt level. But when you look at how is that impacting the underlying economy, typically we had, a lot of these government transfers. We talked about that fiscal level. We saw that cash go from the Treasury to the people. Well, what has happened? Well, lower retail sales have been due to the delta and fading pent up demand, because that demand was met. We had some of this cash coming through, and now a lot of this demand has been met. And that's where we're seeing this drop in non-spec stores, clothing stores. Then you look at the trend of household goods, non-store goods. The trend continues to move lower as a lot of these needs are met, and the savings that have been sitting in people's accounts have now been pushed back into the market, and you're starting to see things kind of get back to normal as we see these retail sales adjust, where services are going up, goods are coming down a bit, and you're starting to see that compress. So then when we look at, well, there's always that backdrop. And that's why when we look at just talking about consumer retail sales, those come down because you have all of that front loaded. So when you look at that fiscal impact, you get this big boost, but a lot of that boost is pulled forward. You get a check in the mail that is for $700. You're waiting to buy that dryer or that washing machine set or something along those lines. Well, that's now you've pulled that forward, and you're going to start to see that come down, and you're going to have that negative fiscal response. So you get a lot of that demand pulled forward. And then you get this slowdown that, depending on the size, obviously this one was massive, will then expand over time. And then the more debt you need to maintain it, the bigger and bigger that underlying overhang becomes, and the longer it takes to get back to some sort of normalcy. So you're kind of getting an idea, looking at this, just how we're gonna have some of this overhang and essentially an anchor keeping some of this growth down and weighted over the coming few periods, couple quarters. So then when we look at this divergence, so this is one of the things that we keep talking about at the lowest quartile and the highest quartile. So the lowest quartile continues to get better. We're coming up to where we were in 2019, where the highest quartile is continuing to get worse, and it's at the lows that we saw in 2018 and 2019. And the reason why is you have inflation. So this is looking at the wage tracker. So you're looking at factoring in inflation, and you have people retiring. So if you've worked at a company for 30 years and now you're retiring, you've gotten, wage increases based on living wages, maybe gotten promoted a few times, gotten a better salary, and those individuals are now retiring. So you're not going to replace them with the same salary. So you're going to see this just essentially reweight lower at the highest level, where on the lowest level, you've seen them essentially get underpaid, or, essentially stay flat from, 2016, a little bit of an increase into 2018, 2019, and now you're coming back up to that quartile, that elevated level, but a lot of inflation, a lot of pain that they're experiencing on their day to day. So even though you're seeing an increase in wages, it's really not a huge movement, and you're not going to see people taking an additional trip to Disneyland or Disney World at the lowest earning quartile because they had this increase. This is more, I can now live, I can now start to, at least meet some of these rising increases because I've already drained my savings. Savings is very different depending on what quartile you're at, and we'll talk about that in a minute. But these are some of those pressure points. So now when we break it out into the total quartiles, you can see that there's pressure across all of them except the lowest. So when you look at the lowest level, that's where we're seeing the biggest increase, where everyone else is continuing to trend lower. And that's where we continue to see a lot of these pressure points that keep coming through, that keep essentially this cap on what is that consumerism, what does that retail sales look like, what is that pent-up demand? Because as you see wages compress at the highest level, those are the individuals that usually spend the excess because they have excess. As their wages come down or don't grow with inflation, that's going to eat into some of that spare earnings, that's going to eat into that spare savings that we've seen, heard, talked about, and you're not going to see that come through the economy in the same way that I think some are expecting. So then looking at, track per hourly pay, the paid hourly is starting to come back up, but you can still see it's not really adjusting all that much, where the not paid hourly is seeing that big decline. So you're really just seeing essentially a little bit of a shift where salaries are not coming up to meet where a lot of these inflation is. It's not keeping pace with it. People are essentially going to have to pay the difference out of savings, or put less into savings, or spend less on discretionary products, because they're going to have to meet some of this rising cost that is impacting them across the system. Now, the growth in unit labor cost has also started to come down. So we've seen some of this rally, we've seen some of this increase, but now it's starting to cool off a bit. And this is the matter of trying to manage labor, because labor costs have come up. You've seen companies try to manage their inflation, their cost, and the prices that they have to charge, and it's been trying to manage labor. Can I do more with less? Can I leverage that salary individual to do more hours, not pay them anymore, and not have to hire someone new at a higher cost? So these are some of those pivots that we continue to see that are acting against, I think, some of that inflation, because they're like, well, labor's costs are going down, hence no inflation. And it's like, well, inflation's being managed because they can't keep increasing their cost. They have to adjust given some of the different backdrops. So this is going to be some of those underlying pressure points that we have to look at and continue to address. So then when we look at job postings, you can see some of the slowdown has come as we're getting towards the end of August. You see, job postings have come down for minimal education, extensive leisure, hospitality. But seasonally speaking, it normally happens this time of year. When you look at 2020, you see that drop that happened between June into August. So you have a seasonal slowdown. You're still in a growth profile, except when you start looking at extensive education. Some of these are starting to come into the negative category, but you still see a positiveness. But when you look at Indeed data, you're starting to see that flat line, because you're starting to get to a saturation point, and now seasonality is going to work against you. But then when we look at consumers' intention to spend, it improved a bit, but again, this is what we have been talking about. there's not this pent up demand. Like when you look at last year, you look at 2020 and you look at what happened at the beginning of the summer, then at the end of the summer, you saw this pick back up, and you're just not seeing the same type of level. It's very measured. And it's because those prices and those wages are keeping people, fairly capped in terms of what they're able to turn around and spend in the excess. And then when we look again at U.S. personal savings as a percentage of disposable income, it continues to trend lower. Still elevated versus 2019, but coming down. And as prices go up, cost of living goes up, that's going to keep some of that bid within it underlying. So then when you look at what is the Fed expected to do, because, as we'll talk in a minute, the RRP has set a new record. Good job, boys. We're at 1.14 trillion, and which means that we're in spitting distance of 1.2 as we head into month end. So the expectation it has started to shift when we look at August, where a September FOMC is the expected period of when we're going to see a taper on, or a signal to tapering. Again, talking about a cut to asset purchases. But if you look at RRP, you look at debt to loan ratios. You look at cash assets to loan ratios. You're at a point where we should have already been doing this, as we talked about last week. And again, this is just reiterating what we've seen. But then when you look at what are the expectations, so do you consider the current fiscal policy to be, and 49% said too stimulative and 45% said about right. So you're starting to see this movement as we get into August, that we're just starting to do a bit too much, and you're starting to see a lot of that overheating, which then do you consider the current monetary policy to be, and when you look into August, too stimulative. So we've gone from about right into August and March, and now we're coming to the point of, hey guys, like it's time to really consider what's happening. And you can see that it was never too restrictive, because that would have been, maybe people didn't understand or clicked the wrong button when they said too restrictive. But that's where you're starting to see this shift, where it's getting to a point of insane excess. But then when you look at consumer current condition indicators, so consumers are starting to get a bit worse. And this is why we look at the last 14 days, the last 28 days. It's still in a positive move, but you're starting to see some of this softness, and you're starting to see that come through. And it's based on wages. It's based on their financial situation, because they're looking at their current wage, they're looking at their cost of living going up, and they're looking at savings, and they're saying what they're seeing, which is additional fear or uncertainty, which is why expected household income in 1 year is expected to come down, but expected real income in 1 to 2 years has gone through a floor, because again, they're looking at, well, am I really going to get paid more? Am I really going to get a big bump in my salary while I see my prices continuing to go up? And this is some of that uncertainty, which you're starting to see in some of that Chase consumer card spending, where over the 2 years, we're still up, but change from pre-COVID, you're starting to see some of this normalizing, or this kind of flatlining in general, as you see some of these pressure points starting to emerge, and guys looking to pull back on some of their spending. And then when you look at the U.S. reasons for difficulty hiring workers, when you look at lack of qualified applicants unwilling to accept compensation levels, candidates rejecting job offers for other reasons. So when you look at lack of qualified applicants, this is what I talked. So when I spoke with Ryan Ray on Tuesday, I said, like, right now, companies are equally as picky, because they're like, look, you don't have the right skill set, and there's a lot of people unemployed. I'm going to wait for a better asset. And then you look at applicants, they're saying, well, you can't pay me this. I need more because my price is going up. And that's them essentially rejecting the job, because the company says, look, that's the best we can do based on all of these other things. So you keep getting this. Again, there's a standoff between companies and employees, and there's going to be some marriage in the middle, but it's going to take time to figure out at what level. So then when you look at business conditions expected in 1 year and current conditions, you see things continuing to deteriorate, especially in expected. because they see the issues with labor, they see the issues with supply chains, they see the issues with their inventories and being beholden to some of this cost, which is going to be an underlying problem. Which is why when you look at the HPS Economic Sentiment Index, it continues to drift lower since August. Looking back to August 2020, we're at now a new low going back through 2020. And it's really being driven by housing, in terms of the benefits of a new home, major purchases, U.S. economy. A lot of these, the new job is starting to soften a bit, nothing crazy, personal finances, waffling around here, but it's looking at the economy. It's looking at major purchases, looking at home prices that have people essentially sitting there saying, well, I don't feel comfortable with this underlying backdrop and where this is going, and it's going to cause me more pain in the future, which is why we're seeing some of these problems. And then when you look at the economic surprise index from Citi, you can see that things continue to worsen, deeper into negative territory because we continue to have economic surprises on the downside. So if we're expecting a PMI of 60, it's coming at 57. Still expansionary, but again, the expectations continue to be missed because things are cooling off faster than I think the underlying narrative and what people are viewing in the market. And as the S&P hits a new all-time high, it's hard to see, okay, well, you're looking at the data, you're looking at the slowdowns, but then you look at equities and you're like, all right, something doesn't drive here. But, it is what it is at this point. And now in the next segment, we're going to look at PMIs and some of the hard data. And by hard data, looking at, economic leading indicators as well as real estate, and giving that deeper dive on what's happening with real estate going forward over the next few months based on what has happened, what's happening now, and what do we expect to happen in the future.